Hi guys, it's Chad Larson with MLD Wealth. This is June's Money Matters MLD Market Wealth Commentary. I've been doing this for ongoing a couple of years now. It pains me to not to look back on all the calls we've made, but we've gone through a lot, and I've tried to keep the format as casual and as armchair as possible, and just give everyone a chance to see me, hear from me, get my take on what we're seeing in the marketplace, what our positioning strategies look like, what happened in the market, and more so, what do we anticipate happening? There's a reason that the rearview mirror is small and the windshield is big, and what's behind you is behind you, and your future is in front of you. I think more than anything, very touching quickly, because it's some of the commentary that I'm seeing a lot. I've been pounding the table over the last number of months around deployment, and I don't want to say they use the words aggressive, but we have been constructive and been deploying actively and reducing cash balances, and it's worked out very well. The S&P has reached record highs. It touched them, interestingly enough, 8 times during the month. So bouncing continually off the highs. And, making new market highs does not bother me. If the market's never made new highs, they would never go up. And go back to 1910, and if that was the market top, boy, has a lot of things changed. So I'm not so worried about that at all. The undertones of this is something I've been talking about for the last couple of months. Is we're just starting to see. We know we were through kind of the quantitative tightening or the restrictive monetary policy portion of the market, and the Fed has signaled there's no more hikes. Interestingly enough, I did wait until a few days into the month so that we could at least get the Bank of Canada's decision in, which came in today. So if you haven't heard, the Bank of Canada was first to cut. So the Bank of Canada did cut overnight lending rates by 25 basis points. So a divergent strategy from the US. So Canada led the way. I said they would. We get a few things right for a number of reasons. Canada is in much dire shape, comparatively that to the U.S. economy. How mortgage costs are on the steep increase in Canada, and the Canadian consumer is far more geared or susceptible to high mortgage rates. In the U.S., you can lock in your rate for 30 years. So these higher interest rates really haven't hurt the U.S. homeowner, but they're really hurting the Canadian homeowner, along with a tight housing supply. Housing costs remain high, mortgage balances remain stretched, and I've been talking for almost a year where I won't name the names, but if you really want to nerd out and spend some time reading through financial statements, there's a couple of the big banks have already started some blend and extend programs, which is nerd speak for amortizing mortgages out further and allowing some accruals of interest to be paid in interest. So it's kind of making interest payments on your interest payments. And so Canada had to move quickly. The Liberal government has blown out the budget so poorly that we're in this position now from weak budgets and a floundering economy due to lack of investments in some of our core resources. But the Canadian index performed positively, however, less than the U.S. And for months we've been fixated on having an overexposure into the U.S. economy, and that is playing out well. The S&P continues to benefit from the outperformance in the technology sector. Today, actually, NVIDIA passed Apple over a $3 trillion market cap, kind of seemingly an endless stock chart of wild gains. But here we are. So from a sector's perspective, technology continued to perform well, driven by innovation and strong earnings. Energy saw a negative price change in the market, mainly due to decrease in oil and gas prices. Some cyclicality into that, but remain. We said this, and it can go back that we were bearish the commodity, but bullish the equities. Valuations remain incredibly cheap, and so we're still maintaining exposures in those spaces. Materials, copper had its day. Material sector saw significant gains due to higher commodity prices. So that trade looks like we were maybe early in it, but no one rings the bell for a bull market. Happy to be participating in that. Financial stocks improved, reflecting kind of some economic recovery and interest rate expectations. I think more broadly in the US, I think it's still a little bit early in the Canadian banking sector. I think a lot more provisions for loan losses are going to need to be moved over from the earnings side of the balance sheet. More trends for June. Tech's going to continue its momentum. Things like industrials, materials, and energy are probably going to benefit from anticipated lower rates, and we saw that today. So, referencing that decision in Canada. So, yes, that takes some reprieve off of the consumer. It will help bolster real estate prices, which have been slipping across the country. But the U.S. is going to remain higher for longer, and I kind of want to go into a little bit of a diatribe about what that means, because as much as I haven't glazed over interest rates over the last number of podcasts or market updates, it's interesting to understand when there's really a divergence. When things are all moving in lockstep, I can handle pretty much anything other than the thing I wasn't expecting. Uncertainty is a very negative place to be in the marketplace, and when things kind of diverge from their mean is when you can have significant problems. So, the Bank of Canada and the United States Federal Reserve, they parted ways today. And this could mean trouble for the Canadian dollar. We've seen weakness. Well, Canada's central bank has cut its interest rate. The Fed isn't. And to ensure the gap between policy rates that, as they've diverged, could have some knock-on effects. I'm not alone in this consensus. It's pretty unanimous across the board among economists. To look at those impacts back at other times in recent history when the Bank of Canada has kind of gone on its own. You can historically, a difference of about 100 basis points looks to be the comfort zone. We're only 25 basis points divergent or different today. But, I can throw up some charts about examples where that gap has sometimes yawned considerably wider. Going back to 94, 95, the Mexican peso crisis, the Bank of Canada slashed its rates from 8.1% to 3% because the economy took a massive hit. Canada's GDP was so weak that supply was really outstripping demand, and inflation, became an issue. The U.S. economy was in much better shape, allowing the Fed to only make modest adjustments. And by 1997, the difference between the two countries' interest rates was 2.5% or 250 basis points. Rising energy prices, were a buffer to the Canadian dollar then. But when the Asian and Russian financial crisis has slammed commodity prices, the loonie, got crucified down to 63 cents US. So to combat that, to defend the loonie, the Bank of Canada actually hiked in the summer of 1998 by 100 basis points to try to close the policy gap. So, the loonie has fallen to a record low of six. Listen, we're sitting here kind of 70. What are we at here? Dollars at 136.93 as we sit today. Call it in the inverse of that. The dollar's kind of sitting in that 72, 73 cent range. It's far more likely we're going to see a 71 cent dollar than we are an 80-cent dollar anytime soon. And in fact, there's an issue that we seek that I'll kind of get to near the end of this, where we do see some concerns. Kind of talking going back all the way into the great financial crisis, when we got into that, it's important to still bring up between 2003 and 2006, the Fed was forced to hike its rates by about 100 basis points or 1% above Canada, as rapidly rising real estate prices was really spurring the economy to try to slow it down. This time, through soaring commodity prices, and the price of oil doubled over those 4 years. This was the time when the loonie was up at 91 cents and ended up pushing past parity in 2007. And that was an absolute pivotal time within our business where, we made some meaningful bets into the U.S. multifamily complex, and that will lead me into kind of the ending discussion and around kind of the alternatives private portfolio that we launched this week. We've been parlaying capital into the alternative space. I always tell people since before it was cool. But post kind of U.S. dollar parity, what happened next was history. The bottom fell out of the U.S. economy in the worst recession since the Great Depression, and the Fed slashed rates to the zero lower bound, where they remain for the next 7 years. So what does that mean for 2024? Unfortunately, oil prices likely won't come to the loonie's rescue this time. Some chief economists that I follow very closely pointed out in an earlier report The days of Canada's petrocurrency war are over. A decline in investment in Canada's oil industry and more money flowing to investors in the form of dividends and special dividends and shareholder buybacks, many of them foreigners, has meant that oil prices are not giving the Canadian dollar the boost they once did. You're seeing more and more oil and gas companies hesitant to keep leverage on their balance sheets. We're seeing very underlevered oil and gas balance sheets for a number of reasons. ESG concerns from some of the prime lenders, in the modern woke world of transitioning away from fossil fuels. Excuse me. And all the ESG concerns, that oil's bad, has kind of cautioned oil and gas CEOs from significant reinvestment, both in the creation of jobs, additional output, and in the form of creating that wage growth, which would translate into GDP growth. So you're seeing just a lot of the dividends and shareholder buybacks just kind of leak out of the country. So with it, listen, the Canadian economy is absolutely lagging the U.S. A number of banks and a number of economists predicted that we'd be cutting this summer. Well, they did this morning, an increase at the pace at the end of 2024. So, yes, down south in our U.S. Cousins, the Fed likely won't start cutting until December, and eventually the gap between the two rates will likely widen, to probably somewhere between 125 and 150 basis points, or about 1.5%. So this could really risk the currency dropping below that psychological 70-cent US level should a risk-off event such as intensification of any kind of geopolitical tensions, occur. So, we have a lot of data points to point to why this is, it's a concern. Now, I'm not saying potatoes, a point here, a point there, but as we position ourselves as capital allocators and shepherds and stewards of our clients' capital, basis points do matter. Looking at currency efficiency, looking at where we want to deploy capital the best. The thing that could go the worst is where the U.S. economy does exactly what we think it's going to do. It's going to expand, and multiples of expansion, and we do see continued legs to this bull market. We're very constructive, the U.S. market, and very constructive, a synchronized global economic recovery through into 2025. Probably the most kind of optimistic I've been in an entire market cycle. Back to what I really spent a lot of time talking about over the last month and the months prior, kind of the three legs to the stool. We saw a terrible 2022. We saw a very skewed and narrowed market in 2023 being led by, 7 stocks, muting out returns for 2 years. The S&P, starting the year was almost net near flat over 2 years. But yet we saw 10% per annum across the board as a group of 500 companies, 10% earnings per share growth. There's no other highly or sticky correlated attribute to the value of the stock market than earnings per share growth. So we had 2 years of 10% growth and no movement in the stock market. So we entered into 2024 bullish, deploying capital along with what the expectation was. Now, January came out hot. Everyone thought the Fed was going to cut 6 times, and it was cheap money again. And the market kind of roared and kind of started a bull market. Then things tempered, and maybe everyone got a little over their skis, and the expectations that we would be in a higher for longer scenario kind of has played itself out. But that being said, that fuse that was lit has really kind of spurred things along. We do know we're done hikes. Canada started cutting whatever it's to save the homeowner. In the U.S., and again, the U.S. economy being the proxy for the world with 52% of economic activity in the world, it's impossible not to drive that conversation, because whatever they do, we do, except in the case of cutting interest rates. Along with, the estimates are between $9 and $11 trillion of cash on the sidelines, that typically at this phase of the economy starts to dribble back in after there's clear signals that rates are coming down and the Fed becomes more accommodating. So there's a lot of reasons to be very bullish. But I kind of started this rant with saying the worst is if the U.S. stock market does really well and we're surprised somehow, and the loonie sees a rally and you kind of mute out your gains. But we're a long ways from a federal election in Canada, where God willing, we see a shift in the political narrative, and we right size kind of the competitiveness of Canada to be an investable market for foreign investment. So, we definitely, have concerns, but we're very constructive on the U.S. Within that, I do want to spend a couple of minutes. Any of you or clients have seen this through direct communication. We've been on LinkedIn. I'm actually a guest of an external podcast tomorrow. Wanted to kind of talk about, I'd been hinting at it for a number of months or through the podcast, and many of you directly, but, first of its kind in Canada, we're really kind of carving the pathway to delivering, innovative, leading, cutting-edge solutions for our private clients. But in partnership with Obsido, a group based out of Toronto, we have brought forth an exclusively designed for MLD private clients a fund that we've called Alterna Private Income Portfolio. We've been doing alternatives, and what is an alternative? That's any asset class that's not publicly traded. Not your conventional stocks and bonds, but for simplicity's sake, the food groups are private equity, private debt, real assets, and hedge funds. These are massive segments of the market that chronically, the casual or the average retail investor has been significantly, if not at all, exposed to. And these are areas of investment that have provided significant alpha, significant outperformance, but more so really muted out and helped manage the volatility. When we look at how um, Canadian pensions, U.S. pensions, endowments, and foundations capital is positioned, the inclusion of alternative assets is anywhere between 30% to 45%. Public equities and public fixed income make up the smaller portions. There's no such thing as a 60-40 when you have a lot of money, but there hasn't been many great options for investors. Now, through the relationships that my partners and I have cultivated over the last umpteen years. Fun fact: I think less than 2 weeks from now, I'm celebrating my 20th year in partnership with Curtis Mayer, the gentleman who hired me into this business away from one of the big banks where I was a rookie. We've now celebrated a handshake partnership that's lasted 20 years. So, but going back to alternatives, I referenced kind of the dollar parity scenarios that we saw in the marketplace back in 2007, 2009. And that's really kind of when things really started ramping up, and we made a structural significant bet on the U.S. multifamily, and that was done through private assets. That was done through private real estate. We built structures around them. So the augment, this was not new to us. This was just navigating the kind of regulatory framework, compliance, legal, operational support. But in the creation of the Alterna Private Income Portfolio, we really, struck it out of the park. We've put together an absolute, I believe, the gold standard and best in class product shelf together to deliver a turnkey, efficient solution in an evergreen fashion for clients to participate, and was able to make the structure RSP eligible. So often, a lot of our clients have significant amounts of their wealth tied up in registered accounts like RSPs and RIFs and RESPs, and then their own personal real estate holdings, etc. So even being accredited and even having the ability to qualify to invest in some of these opportunities, the proclivity to create less liquidity and tie up their open money or non-registered capital was worrisome, and was creating some gaps in liquidity that we see for our clients. So the formation of this, there's actually, interestingly enough, like two things I wanted to highlight. First off, like, how big are these markets? Private equity is a $7.8 trillion market. It's averaged over the last 10 years an annualized return of over 16.4%. Real assets is a $3 trillion investment sleeve, and that's real estate, infrastructure, natural resources, etc. So these allocations are typically sought for inflation protection and diversification purposes, whereas private equity is predominantly driven for diversification but enhancing return. The other kind of leg to the chair is private debt. That's a $1.5 trillion asset class and growing rapidly. As you know, MLD has nearly not cornered the market, but carved an enviable niche within the Canadian landscape with having some of the best direct drive relationships for private credit and direct loan opportunities negotiated between private parties at incredible rates of returns with relatively effectively no volatility and very little correlation to public markets. But on average, those 10-year returns have been in private credit over 10% per annum, and we have far exceeded those. It's the fastest growing alternative asset class, largely as investors seek out that class's ability to produce high yields, stable cash flow, and particularly in these rising interest rate environments. And banks have started to huddle and protect their balance sheets, maintaining their tier one capital ratios. And the other one is hedge funds. It's a $4.8 trillion industry. It's a term used loosely, broadly, and largely has negative connotations. I think anything that's not conventionally long gets called a hedge fund. But it's not an asset class rather than a collection of strategies that use somewhat similar tools such as leverage or derivatives or to achieve distinct outcomes. So it's not what it's impossible to kind of even compare hedge funds. One can be a defensive strategy, one can be offensive, one can be market niche related, but those are those four food groups. So obviously our clients have a proclivity. Again, I've used my new big word twice in one podcast, so I promise I won't use it again. Have a lean towards income as our clients transition towards work optional lifestyles or more conventionally retired. But this solution was really tilted towards the private credit bucket, so to speak, less towards alpha generation. So it's kind of 10 of the leading alternative investment managers, two of whom we are the only pipes or the only access points in all of Canada to get access to. Hats off to my partners at Obsido for helping us create this and really leading the charge. And as much as our sponsorship with them allowed them to advance their business model out. It was really their business idea and acumen to forge forward at helping create this. So we've got some incredible partners, on deck between Blackstone, a $1 trillion asset manager, KKR, Apollo Global, Blue Owl, the SAF Group, who many of you are familiar with and have been key cornerstone capital partners of ours for the last 10 years, Oaktree Capital Management, IFM, RPIA out of Toronto, which is a stellar group of credit managers and fixed income managers. Just super excited about it. Many of you have heard about it. I'm going to, people kind of like wondered how an evergreen, and what I mentioned, I would talk about what evergreen meant. Evergreen, is a term that we use in terminology saying that it's ever growing. It's always available. So, it's not, pile in today because we have this opportunity that's has a short fuse to get in and pile on the bus and go on a magic bus ride. But it's an evergreen vehicle such that we do allow for monthly subscriptions. There is ongoing liquidity in the portfolio. It's something that we can deploy tactically and position our clients' portfolios through. And typically most alternatives or private investments have a much longer period in which even the capital is drawn down on. So creating a vehicle that was always going to be available for us to deploy capital to, we're very confident that individual investors can achieve their desired private equity allocations faster and manage their capital more efficiently, as traditional drawdown can take many years just to fully invest the cash and to reach that desired allocation. And during that time, the uncalled capital is typically held in stocks or bonds or cash, and creating a little bit of a drag. So this evergreen structure allows us to day one, invest at net asset value and deploy more tactically. More, time in the market generally outperforms timing the market. It's an academic stat proven, but it's something that was important for us to make available, at a very professional and institutional caliber for our clients. This evergreen vehicle, has the potential to outperform some drawdown funds in an individual's investor's portfolio, but also acts as a complement. An individual investor can potentially even achieve higher compounded returns, sometimes called multiple on invested capital, or MOIC, which you've heard me reference in referencing returns, this is mathematically to achieve a MOIC of 3x over 10 years, meaning that net of fees, investors walk away with 3 times more money they invested. A drawdown fund would need to generate on average about 18% per annum, 18.4 to be exact, while an evergreen vehicle could achieve the same MOIC or return from a net internal rate of return of just 11.6. You have more money working longer, instead of being drawn down and kind of only being invested through those middle years. So that compounding effect makes a lot of sense for us. So this is meant, it's not a kill all portfolio. It's not a one arrow solution. It's a complement to traditional portfolios. It's a complement to traditional drawdown funds and other private equity, private credit, private real estate opportunities that we're going to continue to participate in selectively for our private clients. So I kind of looked at it as a straddle, as saying we're taking a little bit of our equity, a little bit of our fixed income, and wrapping it into a vehicle and accessing some of the best in class, most celebrated, hard to access, if at all possible to access, um, investment management companies in the world, and I couldn't be more excited about that. So that's taken a Herculean effort, by my team, by my firm, by our invested partners that are working tirelessly in the background to drive a solution that would kind of lead the way. So expect kind of more attention and fanfare as that goes on. But I don't want to, we've been kind of 26 minutes at it. As always, kind of in wrapping, the balance of the year, kind of as everyone tees up, the weather's getting a little bit nicer. It sounds like golf courses are wide open and people are harder and harder to get a hold of already. We're excited about the next number of months, the next couple of quarters. It's been a fantastic year to date. I'm incredibly happy with our other external partners through our SMA platforms. They continue to outperform their peers. I look forward to speaking and seeing many of you over the next little bit. At any time, if you have any questions, concerns, comments, please feel free to contact myself or any member of MLD team. We're here to support you, and the only asset that we have, that we hold in custody, is your capital and the relationship and the trust in which you put into us. So we take that very seriously. Have a wonderful month, and look forward to seeing and speaking with many of you over the next coming weeks and months.